What turnkeys allow you to do is learn the very basic fundamental principles of investing in properties without all of the risk and the hardship of the hard stuff, like flipping and negotiating and sourcing the properties and all that kind of stuff with turnkeys, because other people are doing it for you.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is Ali Boone. She's a former aerospace engineer turned real estate investor, entrepreneur, and author. She's the founder of Hipster Investments, where she's helped countless investors, mostly in the turnkey rental space. What makes her unique? She didn't just build a business, she designed a lifestyle. Whether she's coaching new investors, writing for bigger pockets, or snowboarding on a Tuesday, Ali's mission is to help others hack their mindset before they hack their wallets. Ali, great to have you here. How are you today?
I'm so good. I'm so excited to be here. I'm excited to talk to you guys.
Thank you. We're excited to have you. So I just learned a little bit about you in the green room before we got started. You've known Neil significantly longer than you've known me, which is about 5 minutes now. So please tell us a little bit about yourself, your background, and how you made the transition from aerospace engineering into real estate. Tell us everything we need to know about you.
Well, I'll try and give you somewhat of a condensed version of that because that could go on for a while. But the very short of it, we can expand on anything that's of interest to your folks, is I'm a corporate dropout. I did the whole thing, grow up, get good grades, get a secure job, get the dream job, air quotes. And I did that. I was in school for, 9 years through a master's degree, got my first big girl job. I walked into the cubicle for the first time, and before I even sat down, the thought in my head, clear as day, was like, this isn't going to work. Like, I knew it. And I didn't know how I was going to get out of that. And I kind of probably did my company a disservice that I was already thinking of how to get out of there before I ever sat down. But it took me 5 years, and I was just exploring. I had a lot of skills, but nothing really directly applicable to anything that could walk me out of corporate. So I started all the research. I was looking into starting businesses. It seemed like something real estate investing could work. Those two things seemed to be the things that would get people out, but I still don't know what that looked like. Kept going down. I kept coming up with, genius ideas that never really went anywhere. And in that, I was, of course, subscribed to every newsletter possible of anyone who could entertain me during my job. And some real estate investment deals came across my desk. And I started thinking, I was like, well, while I have a steady paycheck and good health insurance and get paid every Friday, I might as well do something smart with my money. So I started doing investments just for myself, not thinking anything much of it. And I didn't start with turnkeys, but turnkeys came up in the whole thing. And I thought they seemed super boring. I was like, I want something more adventurous, but I don't really want to swing hammers either. But turnkeys at the time, because this was during the crash, were very advantageous. And so I finally looked at them kind of reluctantly, and I was like, maybe I kind of see the value here. And I got into it, and it just became a total addiction. And turnkey at the time, turnkeys have been around forever, but around that time is when they really kind of started picking up steam in terms of the term turnkey. People were buying them. And so suddenly everyone's like, wait, how are you investing in real estate without swinging any hammers? And I was like, oh man, get a load of this. Suddenly my mom's friend was buying one. My cousin bought one. So everyone started coming to me just asking, what is this thing you're buying? Who are you buying it through? And I wrote something online about it, and Bigger Pockets ended up picking me up, and I became a writer for Bigger Pockets. Suddenly everyone wanted to know who to buy turnkeys from. And ironically, not thinking that was going to be what got me out of corporate, it became a full-time gig. And that was back in 2011, 2012 timeframe. I ended up leaving corporate, and along the way, so I've been slinging turnkeys since the beginning of time. But in all of that, turnkeys often attract new investors. And so I started working with more and more new investors. I started really seeing, I knew my challenges getting in the industry. We didn't learn this in school. Who do you trust? Everyone's telling you what you should do. It's completely overwhelming. And I saw that with a lot of other people. And I love that kind of stuff. I'm like, how can we simplify a pretty complicated industry? Because the good news is there's a million ways to do real estate investing. The bad news is there's a million ways to do real estate investing. And so, the passive part of this is a big deal for me. I'm location independent, time independent. I work when I want, from where I want. That's a big deal. A lot of people want that. Financial freedom, all the buzzwords. And so I started doing coaching kind of along the way, even outside of turnkeys. Like I can do turnkey coaching, of course, but just people trying to get in this industry. And so that's what it's really evolved into. There's been a lot of progression along the way, but that's kind of the bulk of here we are today. And it's, getting in during the crash has been interesting because as you guys probably know, there have been so many turns of the real estate market. Like I tell people at all times there's a reason not to buy real estate. But what I've seen is you've got to buy the real estate. So it's been a fun journey. There's the entrepreneur side of it for me, the investor side. I've got my own investments. I'm closing on another couple properties next week. It's constant learning. That's the other thing I've learned is that no matter how long I've been in this industry is on the job training, and I'm constantly learning new things just when I thought I knew it all. So it's ever evolving, ever changing. Can be stressful, and I hate it some days, but for the most part, it gives me everything I want.
I love your story. That's why way back in 2019 on our previous podcast, I wanted to have you back. When I saw your name pop up again, something you said there early on was that you explored all sorts of different business ideas, and it echoes so much of the journey I went through, trying to figure out, I think I read 4-Hour Work Week, and it's like, all right, how do I generate some sort of life, create a lifestyle business and, information products and some sort of, whatever, just trying to come up with business ideas. And one of the things that finally sort of drew me towards real estate is that it's really a worn path that you can follow. I mean, real estate when it's done well is really boring.
Yeah. The boring side of real estate is usually the better side.
Absolutely. If it gets exciting, you're probably not doing it right.
I live for excitement, and I'll tell you, excitement in real estate is not my favorite version of excitement at all. Even the boring side of it can be stressful.
Yeah. And and I forgot where I was going with this.
Well, I'll pick it up.
Jump in. Yeah, you pick it up.
Thank you for that. A lot of times we hear about the journey, like Neil's talking about, of like where you started. And eventually so many people find their way into real estate. And then a lot of times with real estate, people follow this trajectory of, well, if I don't have any money, I'm going to start wholesaling. If I do have some money, I'm going to start flipping because I watch HGTV too many times. But wholesaling or flipping, eventually you realize that you're trading time for money. And the day you stop working is the day you stop getting paid. And then that guy, if he's wholesaling and he's doing a few deals and making a few money, he realizes, oh, I'm passing up on some deals. So then he's flipping them. But eventually that guy turns into, I need to start holding some properties long-term because I'm not generating any income, right? Single family homes, maybe they discover BRRRRs. A lot of times, eventually that moves into small multifamily. Sometimes that turns into short-term rentals. Sometimes it turns into mid-sized multifamily. A lot of times, eventually in their mid to late 50s or 60s, that person realizes their time is worth more than anything else, and they look more towards passive investment strategies and syndication and things like that. A lot of times I hear about turnkey as an earlier step in the journey because you don't have to worry about handling the forced depreciation, right? One of the good things about turnkeys is also one of the gripes that I hear. It's that, oh, I don't have to do any work. I don't have to swing any hammers. The work is already done. But one of the problems is, well, the forced appreciation has already been added to the property and you're paying for that. So it takes away one of the abilities to recapitalize for the next one, right? When interest rates are down in that post-2008 crash, especially 2010 to 2013, you could pick up properties for dirt cheap. You could renovate them. You could put tenants in there and hit the 2X rule where the rental income coming in per month was twice, 2% of the purchase price. You can't do that anymore. So at the time, like when you're buying turnkeys, what's the strategy to recapitalize so that you can continue to scale? Because otherwise you're buying 2, 3, 4 and you're running out of money. So what's the strategy to recapitalize and continue to move forward? And then it also seems like it's so seasonal. Like this makes perfect sense when the interest rates are 3%. What about when they're 7, right? Exactly. You couldn't miss. Everybody could win. That Warren Buffett says you can't tell who's skinny dip until the tide rolls out, right? Until things get hard, you don't know. But talk through some of those gripes, right? The forced appreciation is there. So the recapitalization can be hard. The ability to scale can be hard. You have constraints in terms of the capital markets from interest rates. Those are all the negatives, but it's still something that you love to do and something you coach on. So I'm sure, I know you've heard all those objections. So lay it on me. You're the best person I've talked to so far to handle those in a way that is going to help me understand this.
Yeah, for sure. And there's 2 things you're really asking about in this. There's scaling because, unlike flipping a property or borrowing or whatever, you put X amount of dollars in and then on the refinance, you get to capture a lot of that back, rinse and repeat. Whereas a turnkey, if you have $30,000 and you put that $30,000 into a down payment and closing costs or whatever, it's gone. You're not getting that back. So there's the scaling conversation. But before I get to that one, and there's a really good chance I'll forget to come back to that one, so take me back to it. But on the broader perspective, what you're talking about, all the gripes and the complaints about turnkeys, well, I almost want to say two fundamental misunderstandings. I think there's one technically fundamental misunderstanding, is that rental properties are long-term investments, period. So to give you a perspective of this, I call them my core four. I had four properties in Atlanta. 3 were turnkeys. 1 was not. It was the house I used to live in. Keep in mind, I bought these during the crash, but I bought them in an appreciating market. I'm currently dealing with a situation where between those 4 properties, the cheapest one I bought for $55,000, the most expensive I think was $165,000. I currently, with those 4 properties, have $900,000 in equity between the 4 of them and only $250,000 of debt. So grand total portfolio like 1.15. I owe $250, so I've got somewhere like $900 equity. And those were all turnkeys. I didn't put work into any of them. And hello, like, hi. So something doesn't not work on turnkeys. But rental properties are a long-term deal. And what people don't understand, that fundamental misunderstanding, is how rental properties really make money. When you really dive into it, there's 5 profit centers on a rental property. Cash flow, we all know and love. Appreciation is pretty obvious. The tax benefits start to get a little bit more convoluted. Hedging against inflation, that's a hard calculation, but it's a big deal. And equity build during via mortgage pay down. So what I tell investors these days, and I didn't really determine this for myself until I started looking at the equity in my Atlanta properties, because I was like, wait a minute, what has changed about these properties since I first bought them? And, I said there's $900,000 in equity between 4 pretty cheap rental properties. Again, 3 of them were during the crash. So let's call it half of that. That would still be almost $500,000 in equity. And that's, skewing for the crash. But for example, one of those properties started out negative $100 in cash flow a month. It's currently plus $1,000. So that was at the 10-year look back. So I got to 10 years on my properties. I look back, I was like, wait a minute. Okay, now that I've been in this for a while, what did I buy? What worked? What didn't work? What's my perspective here? And that's when it hit me. I was like, it's the 10-year mark that matters. That's when all those profit centers really start compounding. Cash flow. If I tried to sell someone a house right now with negative $100 cash flow, I'm never going to hear the end of it. Like, they're like, oh my God, like you can just hear it in your head. But if my house started at negative 100 and now it's plus 1,000, if you're thinking about financial freedom on the most basic level, how many properties at $1,000 a month cash flow do I need for financial freedom? Well, I'm in LA, so I probably need a lot more than some. But let's call it, if you need $5,000 a month, you only need 5 of those properties. That's very attainable. Like, that's easy enough, not a big deal. But if it's lower cash flow, the number one thing I discounted was the rent increases, because everyone loves cash flow, and the cash flow message is so deceiving. But if we're going to play the cash flow game, that changes over time. So when I'm buying turnkeys, what I'm looking for myself is, because I'm not going to force that appreciation myself, I need the market to do it for me. That's what happened in Atlanta when I started buying there in 2011, 2012. The only reason I got into turnkeys is because all the turnkey guys were like, hey, we know you said this is really boring, but like, you're from Atlanta. If you were ever going to do it, like, we're telling you, this is it. And sure enough, Atlanta, you can't even get cash flow in Atlanta anymore. So like, I'm focused. There are a lot of people buying in cash flow markets. They are completely focused on the cash flow, and that can work over time. But I had $900,000 in equity in 4 properties. I'm like, how am I going to do this again? It's way more challenging right now, but there are pockets that are, I'm working in Detroit and Cleveland right now. They've both been experiencing somewhere between like 17 and 19% appreciation just in the last year. Like, high. So you change your strategy to make the market do the work for you rather than you doing the work yourself. And tied into that fundamental misunderstanding is, God bless the internet. If you type in how to be a real estate investor, you nailed it. Is what's the first thing someone's going to say? Well, you don't have capital, so go wholesale, and then make sure you flip a property and never buy something turnkey or at market value. Oh my God, you're going to lose. That's ridiculous. You've got to force that appreciation. You have got to understand that the process to do all of those things is a very simple process. it does not make it easy. It doesn't make it doable. It can be very risky. I can't tell you how many properties I've walked into that I almost feel like I'm in a warp world where half of the property is completely renovated and the other half is missing all the drywall and everything. I'm like, what happened? Well, somebody on the internet is like, I've got to flip a house. And they go do all the things and they get hosed. They run out of money. Something happens. So if you actually look at the difference of the numbers, and turnkeys are not for everyone. If someone has the interest, the skill, the whatever to go flip a house, I say go flip a house. Don't buy turnkey. I wouldn't either if I were you. I'm not that person though. And there's a lot of people that are not those people. You've got to be a certain person with certain resources and certain knowledge to make the seemingly simple things work. Like flipping doesn't seem hard, but it can be incredibly risky and challenging. So when you put call it the turnkey option and a flipping option next to each other and you run the numbers, by the time you account for your time, your risk, your effort, how much are you actually making? Because if, let's say you buy the distressed house for $60,000, you're going to rehab it for 40. It's supposed to be worth 120 to 150 or something. Cool. In theory, you should have that $20,000 to $50,000 equity. But what happens if there's rehab overages? What happens if there's delays? What happens if there are vacancies? And then you add all your time and effort into it. Whatever that calculation comes to be, your margin is suddenly a lot smaller than it looks like on paper. And if the final total is, call it $20,000 to $30,000 between this flipped project and this turnkey project, that's not really worth it to me. If I didn't like what I was doing, if it was risky and I put all this effort, is $20,000 or $30,000 really worth it? I don't know. You can absolutely buy with the fundamentals of turnkeys in place and capture every bit of what's actually profitable on a rental property. And I'll come back to scaling too, but one other thing you said is the typical order is wholesaling, flipping. They're like, oh, then we'll move to Burr, then we'll hold stuff. I say completely reverse that. Skip wholesaling in general. That's a job. Unless you really want to do it, cool. And you'll learn stuff if you do it, but it's not going to help you invest necessarily. Maybe some ways, but do it reverse. I tell people with turnkeys, even if they're the most boring thing on the planet, even if you have no interest in sticking with turnkeys, do it to start, because what turnkeys allow you to do is learn the very basic fundamental principles of investing in properties without all of the risk and the hardship of the hard stuff, like flipping and negotiating and sourcing the properties and all that kind of stuff with turnkeys, because other people are doing it for you. And make sure you work with a good turnkey provider, because that could hose you too. But make sure you work with a good one, assuming you are. They're taking care of all the hard stuff for you, which leaves you the time and energy to learn how to run numbers, learn how to, what are you looking for in a rental property? Again, I mentioned now, I don't look at rental properties when I said I'm closing on 2 next week. I don't care what the 1 or 2 year mark of those property is. I care what the 10-year mark is going to be. What is this property going to do in 10 years? And with turnkeys, you get the chance to learn that. What does contribute to the highest profits in 10 years? You've got to learn that stuff, how to pick out your properties, how to run those numbers, and most importantly, due diligence. Because even though the turnkey providers are doing it all for you and you're hands off, you have got to do your own due diligence to make sure that you're getting what's promised. Make sure the numbers are shaken out, get your property inspection. And when you can spend the time to learn numbers, due diligence, and what makes for a good property, those core learnings will make you succeed or help you succeed at least through any other strategy you do. If you can just understand those 3 things, because those pertain to any kind of deal you're going to deal with at all. Yeah. Got my words there tangled. But then once you learn those fundamentals, because when you're flipping and you're doing all these complicated things, you can breeze over those basic things so fast and easy that you get yourself in trouble later. Whereas when you really lay that foundation, you can do anything later that you want. So I say reverse course is do the really boring, easy thing now. Learn those basics. And then what I love seeing people do is apply those. Okay, now maybe I'll do the Burr myself. And now they have the more grounded foundation versus the brand new person who goes on Google and they're like, you should definitely Burr property. And they're like, first of all, what does that god awful acronym stand for? Because I still can't say it off the fly of my tongue because there's too many R's. But that's where I think people really get hitched up. So before I move on to scaling, I'll touch base with you guys just so I don't keep rambling everyone's ear off.
Yeah. But so there's an old cliche in real estate investing, which says, don't wait to buy real estate and wait.
Yep.
And that seems like essentially what you're saying here. We interviewed my good friend Alex Felice way back, I think on episode 20 or something like that. And I love one of the things that he says about life in general. He says, find a hobby that makes you money. And for him, he says, my hobby is buying houses. And he's like, if I just buy one house a year, just a boring, whatever, turnkey, I will be so far ahead of most of people that it will make your head spin. Now, obviously, there's plenty of room to make mistakes, but that's essentially sounds like kind of what you're preaching is that, like, look, don't overthink it. We say this all the time: keep the main thing the main thing. This is maybe not necessarily a strategy for somebody who's only, making $100,000 a year and can only, or maybe it is, but because there's a flavor for everybody. But let's go from there, and then let's talk about, all right, how do you scale this?
Yeah. So this is, and I'll probably only go so far with it just because it'd be such a rabbit hole of details. There, if you're starting with, well, let's call it, so I've got $900,000 in equity between these 4 properties. I was like, what am I going to do with it? Do I take out a portfolio loan? Do I pull it all out? Like, wow, because I am doing properties in Detroit right now, and I calculated I could buy, like, with that money at, I think with only about $700,000 of that money, I could buy 17 Detroit turnkeys. And I was like, I'm done. Do I want to go that route? And I decided not to go that route because that's a lot. I'm like, I'm closing on 2 and it's already exhausting. And so what I decided is, instead of rolling all 4 of those properties into a portfolio loan, I'm going to refinance them one by one so I can kind of just dip my toe in the water. So I just refinanced one of the properties, and I'm taking that, I think ballpark, like 180. I'm like, okay, where do I want to put the 180? I'm going to allocate that, make sure, because I don't want to blow all my numbers in Atlanta and suddenly be negative cash flow on all of those because I've taken so much money out. So kind of baby stepping all that. So if you're starting, the reason I said that is, if you're starting with a chunk of money, call it $200,000, $500,000, this is obviously less of a conversation because you can buy a good solid turnkey at this point for between $30,000 and $40,000 between the down payment, closing costs. Make sure you always have a nest egg, as you always should with real estate. But you can really get a nice start there. But let's say you don't have $500,000 to start with. It's a bigger conversation because what I've learned over this, 13 years, 14 years, something like that, everyone asks the burning question of how do you get to financial freedom? And obviously, to get to financial freedom, you have to scale. Well, how to scale if you don't have money? And for the longest time, I didn't totally know the answer to that question. And I can't even say, the reason I'm not going to go into a ton of detail here is because it's not that clear cut. That's what people need to understand. It's not a black and white answer like, oh, well, if you have no money to start, or if you only have $50,000 to start, here's the process to do, and it'll make it happen. Well, there's a reason you haven't heard that process before, because that process doesn't exist. All these financial freedom, you can get financial freedom in 6 months or less. And just assume that's not true. And so the answer to the scaling of the turnkey question is, it's a bigger picture situation. So a couple of years ago, I partnered with a money mastery system, and this is all they do. Their whole goal is financial freedom in 10 years or less, and they actually have the system built out. And I've now partnered with them on the real estate side, and I've adopted their principles for myself. So everything they teach, I'm starting to learn myself. And what it ultimately comes down to is, you have to figure out how to get more capital, because the reality is you need the money to invest. This whole no money down thing, yes, there's absolutely options for that, but it's not, if it was that easy, we'd all be doing it. Not to be cliche about it, but you need money to invest. So the first question is, where are you going to get the money to invest? This comes down to everything from savings. It's going to be easier if you're a 6-figure earner or higher. This is going to be freakishly easier than if you only make $50,000 a year. So we'll be fair. There's certain people that this may not necessarily apply to, but you have to figure out how to save the money. And when you get really smart about it, part of that money savings comes in tax savings. So when you start to bring in tax strategies and you learn to implement those into your income, into your savings, into how you set up your real estate, all that kind of stuff, that continues to add more money into your pocket as well. This particular company works with whole life insurance. If in normal days, if you spend $1 that you own, that $1's gone forever. You put in a whole life insurance policy and it keeps paying you over and over. So you start rinsing and repeating. So it's like you have the money you have, You figure out how to get more of that. You figure out how not to let that money leave your pocket, so to speak, even though when it's technically leaving your pocket. And then once you have all that money, where do you put the money to make those, the income generations? That's where the real estate comes in. And the whole thing, the thread between it all is tax savings. Like, how can you do all of this and never have to pay taxes legally? I like to call it legal money laundering, if you will, but it's 100% legal. Like real estate, for example. If you do real estate right, you really never have to pay taxes on it because if anything, you 1031 exchange, you keep deferring taxes, you write off all these things. So that's why it's hard to get into in detail because this is like months of training to learn each of these components. But the takeaway that I want everyone to have is that it's not the straightforward thing that everybody says. So if you're starting with limited funds, there are absolutely ways to do it, but it does take work on your part. And, we're all big fans of passive income, obviously. We're on this podcast. But you have to put that initial work in. And really for most passive investments, there is an initial time. Like my turnkeys now, I maybe spend like 5 minutes a year on them unless something totally crazy happens. Like I'm just approving work orders, really. It is hands off. But in the beginning, I had to do that legwork. It's the same with scaling turnkeys and even other real estate things. It's not just turnkeys, but if you're going to scale and you're lacking the capital to do it, again, if you have $1 million, we can just, call me tomorrow. We'll spread it out and you'll be fine. But assuming most of us don't have that, if you're willing to put the legwork in ahead of time to really be strategic in how you set things up, and then you have this mindset of the properties themselves are long-term investments, but your investment in this process is also, it takes a little bit of time. This is not an overnight thing. This is not a financial freedom in 6 months kind of gig. You've got to be strategic and you've got to work with the people who, know how to do that. So it kind of didn't answer your question at all, but just to really implant the mindset of, it's not straightforward, but it is absolutely doable. It's strategic. And if you do have the money ahead of time, if you had $1 million and what did I see? I said 700,000 would have bought me 17 turnkeys. I don't remember what my math is on that, but something like that. Even if you buy 10 turnkeys tomorrow, if you just hold those and wait, you're going to be fine in 10 years, most likely, like depending on where you buy and all that kind of stuff. So there's a lot of almost kind of just, almost indirect messages about this is it doesn't take as much as you think it does. It does take time. If you'll let the time do the work for you, you don't have to invest as much to get to financial freedom. And it is a process, but it can be done. Absolutely.
I'd really like to ask some clarifying questions on there because I think that, and I know that if you've been doing real estate this long, we both have thick skin, I'm sure. So I want to get down into the nitty gritty. Like, I was buying single family homes in Columbia, South Carolina between 2010 and 2013. I bought 9 of them and accidentally burned a couple of them, but all of them needed forced appreciation and I fixed them up, right? And I sounded like every other new investor. I was like, okay, per property, I could buy a property and be all in for between $30,000 and $35,000. These are not Section 8, but they were not much better. I would look for brick homes with an okay roof and refinish the floors and stuff like that. And off of each one of them, I would be like, okay, I'm going to make $6,000 a year, right? So I can save up enough money to buy one of these a year. And then once I've got 5 of them, now I've got $35,000 a year, somewhere in that range. And then I can buy one more per year. And then once I have 10, I'm making 60 grand and I'm retired. This is 24-year-old me thinking this, right?
Hey, that's,
and I'm done, right?
That's more than a lot of 24-year-olds are thinking. So I like where this is going.
Well, now I'm on easy street, right? Well, a couple things were wrong there. Number one, quality of tenants in that price point is terrible. And every time somebody's moving out, it was really sad to see things like a kid's bedroom door kicked in or appliances ripped up and things like that. So all the money you make on that property, you're putting right back into it when the next tenant has to move in, and a year's worth of cash flow can disappear really quickly. The other fallacy is that you think you're going to get to the point where you can afford, if your strategy is I'm going to save my way to my next down payment, or on those properties were so low in price point that you couldn't even get a mortgage. You had to pay cash. But if you get above that 50,000 mark, you could get a mortgage. But it's like, okay, if my strategy to get to the next property is saving my way there, you're making the assumption that the price point when you save the money to get there is going to be the same that it is now. And it It's not.
It
It
is.
never
Especially if
is.
you were buying during the crash. That's a rude awakening.
So this brings up another point, right? If I would argue you've got $900,000 in these 4 properties, but I would argue that yes, you've got some great tax benefits there, and I'm super excited about today. The big beautiful deal that just rolled out came out with 100% of accelerated depreciation through 2032. I
Hasn't
believe
passed yet.
It hasn't passed, but it's in there, right? So I'm happy to have that conversation. Hey, throw me a cost segregation study. Let's take the accelerated depreciation. So I get that side of things, but I would argue that on those 4 properties, you didn't make your money through cash flow and you didn't make your money through saving on appreciation or saving on taxes. You made your money through appreciation in the market. Appreciation is a recapitalization strategy. I think a lot of people, there's a phrase out there. I don't mean to be offensive. People say appreciation is speculation. I've got a quadplex that I bought in December of 2020 for $550,000 that I'm listing in 2 weeks for $1.5 million at the beach. That's not because I'm a genius. It's because COVID shot things up like crazy. We live in a small island community. I converted this 4 unit into 4 Airbnb properties and they do well. But I didn't make my money by saving the cash flow. And I did really well by offsetting my medical income by taking depreciation on the property, but I didn't even take all of it, which I'm glad because I don't want to have to recapture all of it. But we're talking about it's going to end up being close to $700,000-$800,000 of equity that was generated by the market appreciating. So if it takes me 2, 3, 4 years to save the money to buy another turnkey because I don't have a recapitalization plan coming by refinancing a property with forced appreciation, when I am finally able to buy that next property, it's likely to be more expensive than it was. And now we're betting on another big bump. Like the bumps that I've seen in my investing career happened post 2013 to 2015, 16 and 2020 when COVID happened, right? That's when we had massive forced appreciation. So it's hard for me to look at that and be like, well, I'm going to buy properties now. And I know that 8 or 9 or 10 years from now, I'm going to have a ton of equity that I can tap into. And the refinance that you're looking at right now, rates are trickling down from where they were 6 months ago or 12 months ago, but the LTV has changed too. Typically, a refinance right now is not at 80% loan to value. It's at 70 or 65 in some markets or 75. So your interest rate is higher. Your monthly payment is higher. You're able to pull less money out to try to buy new properties. And I have trouble seeing the clear scalability to continue to add more down the road. Does that make sense?
Yeah. And I love this. I'm like, this is a sexy conversation. Unfortunately, there's so much in it.
We're weird. We have weird fetishes. Weird like fetishes.
I'm kind of into it. I'm going to be honest. Keep going.
I'm like, there are so many topics of conversation just embedded in what you said. And I'm like, oh man, if we just sat back for hours, we should do like a campfire podcast interview sometime and like hit everything. It'd be so fun. Yes. So I'm going to get to that. One thing I do want to say is, what you said is that the market appreciated those properties. It turns out the properties are going to get more expensive. You couldn't save to get there. I started investing in the time period you're talking about is when, what was the motto? Cash flow is king. And we all any one of us who started in that era heard cash flow is king. And at that time, it kind of was, like we were at 14% cap rates on $50,000 properties. If I knew then what I know now, like, the famous cliche is that was the message we all had. And it has taken me round and rounds and rounds of different learnings to extinguish that theory. I said at this point, when I buy properties, I don't care what's happening in years 1 or 2, assuming I can afford my life and I don't need, the couple $100 in cash flow a month. I don't even care if the property cash flows. I care what the prospect of the property is in 10 years. That's a little bit loose. Like I do care in the meantime, but ultimately it's that 10-year mark I care about more than year 1 or 2, because year 1 and year 2, what's everyone focused on is the cash flow. And like you said, if you start buying properties, people get in this mindset of buying the highest cash flow properties possible. Well, you described it. If you get bad tenants, you end up having to put all that cash flow back into the property anyways. And that didn't really help you. So like I said, rounds and rounds and rounds of me learning that the power is not in the cash flow. There's not a real estate guru out there who has made their riches just off of cash flow. It's in the growth of the property. And when we say appreciation, we all know the housing, the value of the house, obviously. but it also goes to those rent increases. You can look at rent increases like an appreciation. So like in turnkey world, I only operate in certain markets because there's only certain markets where turnkeys make sense and where there's good turnkey providers. In turnkey world, a lot of people love Memphis. It's one of probably the most historically popular turnkey markets. I don't get it. It's, when you look back at the appreciation rates, the rent increases, there's not a lot of movement in Memphis. Now, it doesn't mean if you buy a house in Memphis, it's not going to be profitable because, again, the most basic rental property in 10 years is going to be making you profits, most likely, unless something weird happens or the market crashes or whatever. But when I compare Memphis, for example, to, I mentioned Detroit and Cleveland, like if Cleveland's at 17% appreciation rate for 2024, Memphis is at like 1.9%. That is a big deal. And you said like appreciation is speculation. Technically it is because we can't promise anything's going to happen, but I can be very strategic in where I'm buying. Cause like you said, during the crash, everything was going up. There's been lots of booms. COVID gave us a really weird boom that I still don't completely understand, but it worked. And now we don't really have any of that going on, right? We have high interest rates. So then the question is, instead of the real estate market as a whole being supportive of these booms or whatever we want to call them, it's down to the strategic location. So one thing I love about Detroit and Cleveland, Detroit being the main example, most people think Detroit's still in shambles. I did. I got a call and they were like, how do you feel about marketing properties in Detroit? I was like, awful. Why? That sounds terrible. I got in real estate. Everyone was fleeing out of Detroit. Most of the world now doesn't realize that Detroit is completely gentrified. It's the cleanest, safest, cutest downtown I've probably ever been to. The town is absolutely amazing, but people think the town is still in shambles, which is holding the prices down. So I say it's an investor's paradise. Since I started working there about 2 years ago, the prices are up easily about $15,000. Like the appreciation is very notable. Detroit was number one in 2023, beat Miami with 23% housing appreciation. You have to find the strategic pockets. Cleveland's similar. All the low-income families, not all of them, have been moving out. Cleveland's been getting revitalized as well. And so I start to look for, kind of like we would do if we were shopping for a property to flip, we're going to look for that distressed property that needs the work and it has that potential. Well, if I'm not going to do that from the flipping perspective, I'm going to do it from the market perspective. Right now, Detroit is not nearly as cheap as it used to be, but it reminds me of Atlanta. It's probably not going to have the same boom that Atlanta did, but there's all that growth coming because the world's figuring out how great Detroit is now because it wasn't before, so it's like that unique kind of, off the beaten path. Whereas like Memphis, I don't really know what's happening. So, and people like Memphis, there's more cash flow and it's like, yeah, but ultimately when you run the numbers, like if you actually run the stats and the detailed data over, call it 10 years in a linear market versus an appreciating market, I mean, it's like tenfold. And in that equation, cash flow is not there. Like if we're talking like 100% increase on the linear market, but 550% increase on the appreciating market, hello. And that's irrelevant of cash flow. So, and then to kind of get to your specific question, well, I guess I just answered it, is for me strategically it is a waiting game. What do they say? Like what's the thing about like, if you didn't buy the next best time to buy real estate is now, if you didn't buy it 20 years ago kind of thing. Because if you look at all the track records, look back at the 80s when interest rates were 16%. Those were terrible deals at that time. But if you bought a property with a 16% mortgage at that time and you still have it now, that 16% mortgage is laughable, like just inflation, appreciation, all these things. And so again, it's that waiting game. So even if you buy in Memphis, where it's a pretty linear, nothing big really happens there, you're still going to be pretty well off in 10 years. And as far as the interest rates, like I'm getting, right now, DSCR is about the same as Fannie Freddie. So I'm like, screw Fannie Freddie. I'm getting DSCR because it's way easier. But I think my rates are, I want to say like 6.2 and 6.8, which people think that's high, but it's actually a completely normal rate. We got spoiled by 2, 3s, and 4s. We're in a completely normal interest rate environment right now. And the good news is that I've seen with my properties, the rate today ultimately does not matter. Over time, if at some point that drops, guess what? I refinance and that bumps my cash flow. And so it's that appreciation on the house and the cash flow that you're constantly working. And this is one of the joys of real estate versus putting your money in stocks. Once you put your money in stocks, you just have to kick back and hope something happens. Whereas real estate, you can make pivots. You can refinance to get that lower interest rate. You can rehab, make a fancier bathroom to get more rent. So you have pliability there. So you combine all of those things, and that's why it 100% still works today, even though the market doesn't seem as advantageous or exciting as it was before. But in my mind, you find the strategic options. You really, what this comes down to is, let's see, when was it? Cash flow got really, I want to say like right before COVID, there was a shift where you no longer could invest in properties with a consumer mindset. You had to put your investor hat on because the consumers are just like 2% rule or 1% rule or cash flow. Like any bozo can invest with that mindset and those numbers. Well, when those numbers were no longer there, you have to dive into how properties really profit in order for you to understand that they're completely advantageous right now, like 100%. And so when you can put that hat on, you still, world's at your fingertips. Again, 10 years from now, and not to say everyone's going to have 900,000, I won't even have that, but even if I have 300,000 or 400,000, I still get to rinse and repeat. And the way I look at it, my last kind of comment as I've rambled on, is the way that I look at rental properties now that's newer for me, that I did not look at them this way before, is I almost look at it like a fancy savings account, where if I just put my money in there and I look at the cash flow like the snorkel that keeps me afloat while all these things are happening on the profit side, that's actually what it is. Because I think people have in their mind that it's a more active, like immediate, like I need the cash flow, I need the whatever. But let's say I put all this money into a fancy savings account, which happens to have an address and a city attached to it, and I just leave it. And let's say a big repair comes up, like $15,000. If I put the $15,000 into it now, that's going to be a blip on the radar in 10 years. I've done that with my properties. And, fast forward, it's like, that's laughable. At the point that quote unquote savings account does its job, you just want to stay afloat while you give it time to do that. And that's kind of my new perspective. And the cash flow is only your snorkel in that equation. Again, all things aside, of like, if you're living paycheck to paycheck, if you don't have a savings account, if you don't have an emergency fund, like, there's some nuances here depending on your personal situation. But as a whole, that's how I look at them now.
I love it. Great conversation. For the sake of time, we're going to have to start winding this down. One thing I want to point out is, especially something that Neil and I've learned as self-storage operators in the Southeast, you have deal states and you've got money states, right? You live in LA, but you're investing in Detroit. It's exactly the situation, right? We're doing deals in the Southeast across the Sun Belt, and a lot of our investors are West Coast or Northeast investors, right? So I think it's important to point out there's deal states and there's money states, and you're obviously in a position where you can bring those people together. So I'm curious how that plays out. But before we move on to our last question, I want you to tell us about Hipster Investments.
Hipster has so much exciting stuff going on right now. I'm not going to lie. So Hipster primarily over time has been turnkey matchmaker. I used to say I was a kind of glorified matchmaker. Now I add emotional support dog onto that. Turns out real estate investing is stressful and people get overwhelmed. So just a support system mostly for turnkeys. And then over time, a few years ago, I started offering coaching. I've been doing one-on-one coaching. And now the big exciting thing, I alluded to this earlier, is that a couple of years ago, I partnered with a money mastery company. And I would normally never do that, but this company is so just absolutely epic. And what they allow, so for them, they get access to the turnkey providers. I handle all the property slinging and coaching on the real estate side. But for me and my people, like I said, for the last 13 years, people have asked me how to get financial freedom. And I'm like, well, conceptually, I can kind of answer that, but I couldn't quite get them there from the scaling perspective or like just the life perspective. Now I can offer that. It's not my product, it's somebody else's product, but the worlds play together. And so I'm working behind the scenes on Hipster now of, cool, we've been offering people good turnkeys, support along the turnkey route, coaching, even if it's just general real estate coaching. But now how can we bring these possibilities in? Because like you mentioned, I think in my intro or bio or something, like I work when I want, from where I want. Like it's a lifestyle design. And I feel like we're all operating in a universe these days where we have that ability. There's work from home. There's, how can we live life on our terms and not be tied to the man, so to speak? And so That's what's really exciting for Hipster now is I don't know exactly what those offerings look like right now. I'm building a free online community for just investors to join, to ask questions, a much friendlier version. You go on landlord groups on Facebook and they're terrifying because people are mean. Like it's going to be a supportive place. Just really my goal now is to just bring people together and like, hey, how can we all conquer this industry easier and less stressful? Because again, we didn't learn this in school. We don't know who to trust. We Google it. It's super overwhelming. So I'm really trying to put some efforts forward to kind of chill that out and really start making the industry a little bit more fun for people, more accessible for people, more trustworthy, all that kind of stuff. So there's a lot to come for Hipster. I don't know exactly what form that is in, but it's very fun to be working with in the meantime to build that.
I love it. All right. Final question.
Hang on. So we mentioned we could probably go on for 4 hours. We could do a fireside chat. We don't have that. Neither one of us have set aside that amount of time today. And I'm going to take this question.
Okay, here we go.
So this is a question we've been asking every one of our guests lately, which is, what is one book that you find just aside from your own?
Yeah,
what
I was
is
about
one,
to say, well, I mean.
I had to jump in there. What's one book you find yourself recommending to friends and colleagues over and over again?
I have friends and colleagues in very different worlds. So my book recommendations can be everything from the real estate books to mindset books to, I say the spiritual books, not religious books, just like, mindset, personal growth, spiritual kind of stuff. It depends on what somebody's looking for. I think that's something that gets this is me not answering your question. That's something that gets overlooked is that there's not one thing that plays into any of this. If you want to become a really successful real estate investor, it's not just about reading the real estate books. It's about the mindset. I'd say more of it's a mindset game than it is the actual numbers game. Business owners. Well, okay, I got one. Here's one that I actually do recommend to everyone, regardless of what their question is. Now that I'm thinking about this, The E-Myth Revisited by Michael Gerber. 100%. I don't care if you're not an entrepreneur. The principles that he lays out in this tiny little book, I've read through it like 3 times. I used to just like carry it around like an emotional support book. I think about those concepts at almost every given point in my journey, whether real estate or as an entrepreneur or even as a human, as he really breaks down the difference between different skill sets. And now, when I'm working with turnkey providers, when I'm working with property managers, when I'm working with clients, I can adopt what he says into every situation and better organize the whole thing. So 100%, it's the easiest read on the planet, but I think it's super profound and really applies across the board. But again, it's not just a real estate journey. It's not just a business journey. It's not just a mindset journey. It's all of those things. So I love book recommendations from all of those genres.
I love that. And it is so funny how sometimes you can read the same book multiple times, and each time you get something different depending on what you really needed to hear right then. And it's okay to rotate. Neil's book constantly rotates to whatever coloring book he's really into that month. So anyway, well, listen, Ali Boone, founder of Hipster Investments, thank you so much for being here. We really appreciate your time. This has been great conversation, more conversation I've had about turnkey rentals ever. And you've been really helpful in helping me navigate and wrap my head around that. So thank you for your time.
They're not a fun conversation. Like I said, I didn't even start into them because I thought they were so boring. But as we said, sometimes boring in real estate.
That's it. Awesome. Well, thank you, Ali. We really appreciate your time. Thanks for being here.
You bet. Thanks for having me.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.